Hi everyone. So if you are an option seller and you want to know how professional option sellers basically eliminate risk when they sell naked options, selling puts, selling calls, strangles, that's what I do. I'm up about 8.99% on the year, realized and unrealized. And actually I have an open position on natural gas right now, open position right here. And this is the position that is currently challenged. So the unrealized P&L is negative. And this is a position I might actually use this method to just protect me on the upside because the price has been going up for natural gas recently. But I'm going to go over an actual example with ES of exactly how this method can, basically just change your trading. Definitely did mine, and I used this trick a few times, and many people use it, and it's pretty remarkable. So let's get right into it, and let's see how professionals eliminate risk. Again, it's nothing too crazy. The key here is just to be able to execute properly, and I'll show you exactly with full examples on the graph and on Interactive Brokers, which is the broker that I use. And let's see what's going on. So if a short call is challenged, you will be buying the underlying, in this case the future. Now this is specifically for futures with stocks. It's probably not gonna work as well. Maybe yes, maybe not, depending on how you do it. But this is specifically for futures options, the ES, the NQ, and commodities is what I mainly trade. So for me, it's more for commodities. So if the short call is challenged, then you will be buying the underlying, basically just buying the future contract. Now, if the short put is challenged, then you will be selling the underlying. Now, you'll be placing a tight stop loss orders for the future contract. And this is specifically just if, let's say, you bought the future, you bought the ES future or sold, it doesn't matter, and then the price goes against you right away. So you want to be out for a very limited loss, and I'll explain exactly why in a second. It will all make sense. But basically, what you're doing when you buy the underlying or the future when the call side is challenged, you're protected to the upside. So if the price keeps going up, the future will basically negate the loss that you have on your short call. Same for the short put. And then you'll be just fine. If the price reverses back and it goes down after you bought the future, then you have a very tight stop loss that gets you out of the position. And obviously, you need to structure it in a way where you can actually afford this stop loss for the future. And we'll get to it in just a second. Now, if the price continues to challenge the call or the put, the position is fully protected, just like I said right now. But if price goes back, the stop loss is triggered for a tiny loss. Now, when would you do it? Well, there's really only two scenarios. You would do it if the price reaches your short strikes, which is probably going to happen for shorter expirations. 0DT, 1DT, I don't really do the stuff. I kind of trade more 80, 90, 100 days to expiration, or at least 45 or more, where you don't wait for the price to get to your short strikes. You use this method if the unrealized loss on the position is getting too big. So basically, this method helps you to keep your unrealized loss and your margin requirements in check. Because many times people sell short puts on the ES, for example, and then there's a massive event, the price goes down, but the price is still very far from their put strike, but they are just out of margin and the unrealized loss is way too big, so they're forced to close the position. And if they would have just have the ability to just hold the position, everything would have been just fine. Probably happens 9 times out of 10, if not more. And with this method, you're basically guaranteeing yourself the ability to stay in the position. Doesn't matter what happened. And, if you structure it properly, even make money if it keeps on going completely against your options, which is pretty crazy when you think about it. And again, you can do all of it because you get enough credit from your initial sell. So the key structure or the key thing here is structuring the stop loss properly. So the credit received from the options, from selling a call or a put or a strangle, will cover 60 to 80 small losses on the future contract. So basically, you can enter the position, you can hit your stop loss 60 to 80 times, and you will still have enough credit to cover it up, right? So this is a pretty extreme number, but I will kind of give you really exaggerated numbers in terms of the stop. So this is actually not exaggerated. This is the other way around. This is actually very conservative. And I'll get to it in just 1 second. It will all make sense, I promise. So this is a step-by-step process. So if the call is challenged, what you will do, and you can actually do it, I do it as I open the position. I do it right away just so I have the protection, so I don't have to worry about it. So I have the order ready in the market. And if it happens, I'm gonna get an alert. I'm gonna watch it and do whatever needs to be done. So if a call is challenged, you will be setting up a limit or a stop limit buy order for a higher than the current price for the future contract itself. And attached is a stop loss order for a small loss. So basically, if the price right now is at $100, you'll be setting a buy order or a stop limit buy order. And I'll show you exactly how to do it for, let's say, $105. So when the price reaches $105, it will get you into a position, and you will automatically have a stop loss order attached for, let's say, $104. So you will only lose a dollar in the position, and it's all done automatically. So you don't really have to, be very quick or have, sweaty hands or anything like that. And on the other side, if the put is challenged, then setting up a stop limit sell order for lower than the current price. So and obviously you will have a stop loss attached to this order as well. And we will focus on the put side because most people do puts it on the ES, so it will definitely make much more sense. For me specifically, on my natural gas position, it's going to be on the call side. The risk on commodities is actually on the call side or on the upside, not on the downside, because everyone wants cheap commodities. So when they crash upwards. Now, after we do that, we have two scenarios basically. Scenario one is the price keeps moving the same way after the order is filled. So let's say we buy the ES contract, the ES future contract, because our call side is being challenged, and the price keeps going up. So it's pretty good for us. It means the future contract is in profit, and then we will just move the stop loss order to break even, and then we just basically wait and do nothing. If the price comes down, our stop loss order will be triggered for break even basically, and then it means the position is doing much better because the price came back. Now the second scenario, which happens, is the price reverses right after the order is filled, and then what happens is the stop loss is hit. You will take a small loss. And then what you do after is you just place a new order entry with a stop loss, the exact same way we did at the beginning here. And you do the same thing. So basically, this is why you can take multiple small losses on the position. But then again, if you structure it good enough, then you will have enough credit to cover it very easily and still profit on the position. And then again, if the stop loss is hit after you set up the new order, you just rinse and repeat. And that's about it. This is as simple as it gets. Really, really effective on lower DTE. They're really hard to execute. You need like maybe a bot or something to do it for you. But on higher DTEs, really easy, really chill, works really, really well. So this is the ES contract. This is the current contract. So let's say we're going to sell the 4,500 put, right? So the short put strike 4,500, and we get roughly about $1,000 in credit. Now this is with about 80 some days to expiration, but I'm just gonna round up the numbers here, but this is approximately the real numbers that we're talking about. This is not fictional numbers. The credit here is actually, I think, a bit more than $1,000, but I'm gonna round it down for $1,000 for simplicity's sake. Now, let's say we sell 4 contracts, and receive a total of $4,000 in credit, because usually nobody really sells one contract. I usually don't. And then what happens is you will be selling one ES future contract with a stop loss of $1, which means you're losing about $50 on the position or on the future itself. And $1 by $1 just means just 1 point on the graph here. So if the stop loss hits 10 times, we will be losing about $50, or $500. And let's add some slippage and fees, and let's double the amount to $1,000. So you have $4,000 in credit, and you'll be losing about $1,000 to protect your position. I think it's a pretty good deal because you're still going to be profitable. And if you really want to go all out and really protect your positions, you can sell, instead of selling one ES future, you can sell 4 of them, right? So the ratio depends up on you on how much you are willing to use from your credit. Now, obviously, you want to use get the most protection for the least amount of money. So usually the 1-to-4 ratio is usually the best from what I found. So for every 4 option contracts, you will buy or sell one of the underlying future contracts. And then you're looking for a very, very small loss, usually 4 or 5 ticks. So this $1 loss is about 4 ticks. And obviously we'll have some slippage. So you'll have to calculate the slippage. So it can hit it about 10 times. Now, this is not the 40 to 60 or 60 to 80 times that I've talked about before, but this is all exaggerated, obviously. Usually, slippage is not that massive. And again, this probably will not happen in a row. Many times the price will keep going down in this case, and you will move the stop loss to break even. So where would you play? So let's say we are here today, Friday, May 9th. You just sold this option, so you get filled, everything is good, and you just want to let it expire worthless, let's say. So I would go ahead and I will probably, and again, this can change depending on what's going on. So, we know if the price maybe crashes and gets to this point, so 5,400, this is where I want to be placing my sell order at 5,400 on the ES contract. So this is where I will be entering a short position, and then my stop loss will be just $1 above, which is 54.01, which is really hard to show here, but you get the point, right? And this can change, obviously, because if you're really deep into the position at this point can still be, like at break even or like at 0% for the option itself, for the put option. This method is specifically designed to control your margin and your unrealized loss, because this is usually what happens. Price moves against you really quickly, margin inflates, and the unrealized loss also inflates or goes up significantly, and then you basically don't have enough margin or enough liquidity in your account to be able to hold the position open, even though there's so much room until your 45 put. So this is actually very similar to what happened just before April 3rd right here. So the price was about the same thing. So and also VIX was about the same thing. So if we just go back and we do this, so let's say you completely avoid the notion that Trump is going to impose some crazy tariffs on the entire world, and you decide to open a position on April 2nd, right before he announces the tariffs. You do the same thing, 4,500, $1,000 loss, or a $1,000 credit, 4 contracts, and you place a sell limit order or a stop sell limit order with a stop loss over here. So obviously this is not exact depiction, but on this day a lot would happen. You would not, the order will not get triggered just yet. And then the day after, the order will get triggered. Even if you will get stopped out a few times here, eventually it will shoot down and stay down. So you will get into a position here eventually. And what will happen here is your future contract will basically negate the loss that you are getting on your options to a certain point, right? So this is not basically to protect you all the way down. If you want protection all the way down to 4,500, you will need to buy the exact amount or sell the exact amount of ES future contracts as you will sell options. So you will sell 4 instead of 1. 1 will protect you to a certain degree, but if you sell 4, you go all out. But again, it might cost you more money in case the price kind of bounces around and hits your stop loss. It might not. You might just get a really good fill, and it happens pretty often where you get a fill and it just goes down, or it goes, in this case, down your way right away, even if it's a few ticks, and you can just move your stop loss right away. It happens, to be honest, most of the times. So if you go 4 contracts here, the price goes down. Well, in this situation, you will be making so much money. The futures contracts will not only 4 of them will only decrease the unrealized loss on the options. It will outpace them, and you will actually be making money at this point, right? So in this case, if you're really not sure what's going to happen, you can even exit for a profit. And this happens. This is this is all real. This happens, and then obviously price goes down even more. It's up to you how much protection you want. It depends on what's happening. It depends on fundamentals. I'm not going to go into this video, but I do have a 5.5-hour course for fundamentals for commodities. I'll link it in the description below. But basically, this is the whole story. And then obviously when the price recovers, let's say our stop loss is here, we will just exit at a stop loss. and then your puts will be just fine, and they will be profiting just as well, because volatility really fell down when the price went up, and so you might be doing really well. And you might just set maybe another order here or here. It's completely up to you. But this is the framework of what you're trying to achieve. It can be really aggressive. Instead of doing 1 to 4, you're gonna do 1 to 1. So you will sell 4 ES contracts, like I said here, and you'll be making a lot of money on the way down. A lot of money on the way down, basically with no risk at all, because you have this put. So if the price keeps hammering down, you'll be doing really, really, really well on your account. This can be done to the top side or to the bottom side with the ES. The only real risk is to the bottom. Can be done with 0 DT, 1 DT, whatever. Now let's see, how would you set a stop loss order for the 5400 in the case we open the position, let's say today, before the market closed. So let's go and see here. Now this is my demo account. This is where I experiment, do a bunch of stuff, really useful, and open the same positions that I open normally on my actual account. It helps with the testing and see what happens after you close the position. So on the order entry, and this will be pretty similar for most brokers, you will go to ES futures, and we will just use the June futures. Now we will be selling, right? Just quantity 1, and we will be using, I use stop limit. You can use just stop, and we are looking to enter at 5400. So 5400. And then 5400, and then you will need to do a trigger outside of regular trading hours and GTC. Now we will go to the advance, and we will do and attach a stop loss order for, this is good, for, here we go, 5401. That's all I need to do. You submit, you override, and that's it. And it's really important that you do it this way with the stop limit, because you're looking to sell when the market is only going to reach this point, right? So this is not, so you cannot place any limit orders. It has to be a stop limit or just a stop order. If it's a stop order, then it will be basically you will have slippage. Without a stop limit or without the limit, it will just be you will have slippage. But with the limit, it basically ensures that you will have an entry at 5400. Now, for myself, I will probably go ahead and I will maybe set an alert right here, right? So if the price gets close to this level, I can see what's happening, can see if the order is filled, everything is okay, and I can manage the position from there. So hopefully this video was really, really useful. I think this is the bread and butter. This is what professionals do, really. This is, I don't want to call myself a professional, but I've been doing it for quite some time, and I work with some big accounts. The account that I showed you at the beginning was the one I can legally show. This is just one of my smaller accounts. So hopefully, again, this was really helpful. If you're interested in any questions, email me below. And I think that's about it. Clears everything up. And good luck for you in your trading journey, and I'm sure it's going to be a good one. Now you have a really good protection tool, or you can use a stop loss, up to you. But this is definitely a way more advanced way of protecting your position, and you will be blown away by how useful it is with higher DT specifically. So thank you so much for watching. I hope you will have a good weekend or a good day if you're watching it during the weekday, and I will catch you in the next one.